Hi, it's Bob Hoopsher, and this is the Gaining Perspective podcast, where we bring you insightful conversations with some of the top thought leaders in the investment advisor profession and investment management industry. I am the founder of Advisor Perspectives and a vice chairman of Vetify. Kaiju Worldwide operates under the belief that the potential of predictive AI is limitless and is driven by the desire to create better outcomes for investors and industries through responsible innovation and common data standards. The company applies predictive AI across diverse fields, including investment management and maritime navigation. When it comes to investment management, it uses the power of AI across private and public investment funds, including ETFs, to unlock new value for investors. My guest today is Ryan Pennell. He is the founder, chief executive, and chairman of Kaiju. It is a technology research and investment company that operates a portfolio of enterprises built around predictive artificial intelligence. So, Ryan, I'm going to have you start by telling me about your career path, what led you to found Kaiju, and a little bit more about your role there.
Sure, and thanks for having me on, Bob. It's always great to have an opportunity to talk about predictive AI. In terms of how I came to be where I am today, I have a background in applied cryptography and theoretical physics, specifically pattern recognition. Um, and that led me circuitously to systematic trading, again, pattern recognition based trading, ultimately portfolio management for a large systematic hedge fund, and then a fund manager in my own right. And about 5 years ago, I realized that if systematic trading or quantitative trading, however you want to refer to it, was going to have any future, it was going to be driven by machine learning. And I'd used machine learning in random number generation systems and applied cryptography. I knew the power. They were not as sophisticated as they are today. It's obviously a rapidly evolving ecosystem, but I knew that was the future for quant strategies because it would keep them evergreen. If anyone's had negative experiences with quant strategies in the past, it's probably because they work for an indeterminate amount of time. Eventually the market changes, market participants evolve, come, go, and the system breaks. And you're not sure whether it broke because there's a short-term change in market condition, or if it broke because that is never coming back again. That environment is never coming back again. And the beauty of machine learning is that it can evolve over time. So that's how I came from one to the other.
So, talk a little bit about Kaiju. How long has it been around? And more importantly, how does it apply predictive AI to investment products?
We've been around since 2015. Really, we're a company called Synergis at the time, and we changed our name to Kaiju in 2018. And really, that was an evolution of funds that I'd run in the past. We started as a private investment management firm, and it was the first time that we did it with this globally distributed workforce, 13 different time zones, and being able to select expertise from sort of the top of the food chain as opposed to the top of the food chain wherever you were jurisdictioned, as I had in the past. It was a very interesting development. It's been enormously successful from my perspective, and it's a really nice community to work in, highly collaborative. In terms of what we do here with investment products and strategies, it's limited to the bailiwick where predictive AI is strongest, which is in systematic trading, pattern recognition. It's never going to be, whether generative or predictive AI is never going to be substantially useful in global macro or predicting interest rates 15 months ahead of time. It just can't do that. But in terms of recognizing recurrent patterns, it's highly accurate in the short term, and that's where we apply it, sort of in the 3 to 8 day window.
The idea that you're going to create investment products that capitalize on the identification of these patterns and know when there's an investable opportunity.
Exactly. So we start with a human incepted ideology for each strategy. So, for example, we want to create a strategy where we're going to trap price in a corridor and we're going to farm premium from that strategy. So, you have spreads, disparate spreads above the market, disparate spreads below the market. You don't really care where price goes. You just care that it stays between the two spreads. And there are patterns that indicate, in our experience, that an equity is likely to stay inside a corridor for a specific amount of time. In our case, the amount of time prior to expiration. So as long as it stays there up until expiration, we really don't care what happens after that. So it's an ideology that the machine then learns and refines and ultimately, from our experience, perfects. And that would be one strategy. And then we'd, for example, in our NYSE listed ETF dip, that simply looks for artificially oversold stocks. So something that's been in an HFT collision, or something that, due to liquidity pockets or voids, has been oversold beyond what we believe its fair market value to be. It buys the dip. And then there's a low to high mean reversion that occurs, and we bank the profit and move on to the next opportunity. So it's high turnover, daily rebalancing anywhere in the 1 to 7 day range. Other strategies are 3 to 8 days. So again, each strategy gets its own ideology. And from there, we holistically combine strategies across portfolios.
So you have an ETF. What types of investors are you targeting with that? And do you have other investment products besides the ETF that targets other types of investors?
Sure. So the ETF we launched as a public facing proof of concept. We've been running the private strategies for about half a decade now. But of course, those are private funds. They're Cayman based and British Virgin Island based. They're suitable only for sophisticated investors. So, high net worth, family office, institutional wouldn't be suitable for your average investor. We wanted to bring the technology to that investor group. The way that we saw that was the easiest to do it was through an ETF. And so we built this first entirely AI curated and directed ETF. And we picked a fan favorite strategy, so a buy the dip strategy that a lot of retail investors have had, periodic success with. They love it, they hate it, they keep coming back to it. And the challenge, I think, for them is it's difficult for a human to recognize an authentic dip versus something that's selling off for good and legitimate reasons. And we thought that the technology could efficiently be applied to that and yield decent results. So we were looking for it. We operate the ETF within the S&P 500 large cap universe, some NASDAQ 100, and some giant cap index ETFs in that portfolio. So it's a stable, and I'm using air quotes here, relatively safe universe of assets, all large cap. And we're looking for it to be complementary to somebody's S&P tracking holding. So whether it's SPY or IVV or whatever it is that you've decided to, you know, give you some beta alignment, this has been designed to slightly outperform. So if you wanted to allocate some portion of that to the DIP ETF, you would arguably experience your beta plus performance using the exact same universe.
What are the performance metrics, and what evidence is there that AI is really more accurate when it comes to investment decision making?
We've been running it for about 14 months so far. In its first full year, which was 2023, it returned 9.76% net of all fees with no human intervention whatsoever. We never touched it. We never, I mean, it retrains nightly and every week anyway without us. So it certainly didn't need us. It performs 2 billion daily examinations to make its decisions, which is more than I'm capable of doing. And that's within a 40 act space. So, I mean, compared to the strategies we're able to employ on the private side, creating and running dip was like trying to swim with a cinder block strapped around your neck. I mean, forced daily trading, forced. We have to trade. We have to hold positions. We can't sit in cash. Forced diversification along arbitrary weighting. It's a tough environment versus an environment in which you can just let the AI be the AI, and so long as it stays within your risk metrics and is in line with your trading ideology, it can just go. So we feel that it did extremely well. I mean, if you're looking at the S&P last year, and you remove those magic 7 or magic 8 stocks that basically provided all of the upside performance, the S&P 492, let's call it, did not do well at all. And dip vastly outperformed that. Again, not using momentum securities. It's not programmed to hop into Nvidia or Facebook or Microsoft or Google when they're running. It's just taking down these low to high opportunities. So we were hugely pleased with how it did in its freshman year. On the private side, well, then you've got returns in the 24 to 51% per strategy. But again, that's in a much more fluid environment where, with the exception of adhering to the guidelines that we insist the system adhere to with respect to ideology and risk, it can trade as much as it wants. It can turn off when it wants. It can rebalance when it wants. And that's hard to do in an ETF environment.
What is your thinking in terms of how this type of technology, AI powered investments, will gain adoption in the asset management industry?
I think the bottleneck right now to widespread adoption of AI by, let's say, more traditional asset managers is product availability. AI is enormously expensive to build, it's enormously expensive to run, it requires substantial expertise. And right now, it's by the house for the house. That there are not a lot of off-the-shelf investment solutions available to smaller asset managers, smaller funds, and building them from the ground up. You're talking about commitments in the tens of millions of dollars at the bare minimum. So that to me is, I think, a real issue. And currently, you don't have a lot of companies that are saying, well, hey, we're going to build solutions and then offer them to the broader investment management public. You've got creators that build these solutions and say, wow, this is pretty cool. I think I'm just going to keep it. Right? I mean, we know who builds and uses these solutions. Citadel has them, Bridgewater has them, FMR has them, BlackRock, Vanguard, they all have them, but they're not sharing them at present. And Renaissance Technologies has been doing this for 30 years. And we've got 3 pieces of information that have ever made it out of that shop, and that's it. So that's where I see the bottleneck, but I do believe that will change.
Well, that bottleneck would seem to me to be a good barrier to entry, where you have an industry where the cost of entry is a very high, very large capital investment. I mean, that's insulates you from a fair amount of competition.
It also, I think, directed us towards trying to create access, recognizing that there was an enormous, you know, chunk of the investor populace that was never going to be able to get access to these systems. Like, not ever. If you can't get into one of those funds, you're not going to build it yourself. And you're just, what are you making do with AI washed solutions that aren't really AI? And so I do think that, those of us who are active in this space have a bit of a responsibility to try to create opportunity for those to have access to this that otherwise don't.
We've been talking about predictive AI. What is the difference between predictive and generative AI, and can they coexist, or is you have one at the expense of the other?
The big difference between generative and predictive AI is their end goal. Generative AI is something that's tasked with creating something new. Whether that's an image, I want an image of a panda in a sombrero, or a piece of music, or written content. Write me an essay on Napoleon's greatest blunder, and make sure that it's not Waterloo. And generative AI uses usually unpurchased content in order to train its models. So the only way that it can create a nice avatar for you is that it's gone out on the internet and it's scraped hundreds of thousands to millions of avatars, so it can learn what an avatar is. It learns what an avatar which is pleasing is, and then it can create your avatar. And of course, you see the problem that this causes with copyright infringement and the theft of likeness and personal agency, etc. Predictive AI, on the other hand, is not trying to create anything new. Predictive AI is trying to predict a likely outcome based on what it sees at the present and what it's seen in the past. So, predictive AI is using either well known, well validated data that has been purchased. So, for example, price, time, and quantity, right? We buy that from Morningstar, we buy it from NASDAQ, we buy it from ICE, we buy it from SIBO, we buy it from Opera. We compare them all. We're fairly certain that the end result is highly accurate. And therefore, the patterns that are contained in those data are things that we can have a high degree of certainty will result in the outcomes we think they will. Same thing with an autopilot on an airplane. That's collecting data at source, airspeed, barometric pressure, temperature, etc. And it's making decisions at that moment based on those data. So from our perspective, predictive AI is certainly or can be seen as safer. It's not as exciting because it can't generate, creative content like generative AI can. But yes, to answer your final question there, I do believe they can work collaboratively and should in time. Generative AI is the interface which you're going to interact with. You're going to talk to this system. It's then, if we do this whole collaboration well, it's going to go away and ask a bunch of predictive systems to generate the outputs it needs to then go back and report to you. So we're not years and years away from that, but we're not there yet. The groups that are active in each discipline seem to be active just in that discipline, us included, OpenAI as well, just generative, just predictive for now.
So you're not there yet. What does the future look like over the next, say, 5 years in terms of how predictive AI will influence the financial services world?
I think you're going to see the larger asset managers all using predictive AI extensively because they're investing heavily in it. They can afford it, and they have the data, not just that they have bought over time, but you know, a shop like BlackRock or Bridgewater have their own data, dozens of layers deep that they've analyzed as part of their own proprietary trading systems that they can then leverage within the realm of predictive AI to give greater certainty to outcomes that they believe that they can achieve. So they're going to use it, they're using it and going to continue using it heavily for sure. But I do think you'll start seeing some end user products appearing. I don't think you'll see endpoint decision making products because that's really giving investment advice. If you're saying, "Hey AI, build me a portfolio that will do this for me within this time frame, and I would like you to base that on an 80% systematic ideology, 20% fundamental ideology." At the end of the day, that thing's then now giving you investment advice. Did it get licensed? Who built it? It causes a, quagmire of issues. However, I think you'll see the products appearing at the level of end user analysis or for the purpose of end user analysis. Hey, this is what I want to do with this stock. Given all of the patterns that you're able to see, what's my likelihood of success? Well, in this stock's 20-year history, when it's looked exactly like this, it's done what you want it to do precisely 8% of the time. Oh, okay, I might not make that trade then. It's not to say that it won't, it's to say that it really hasn't done it before. I think that's what you'll see in the short term.
You mentioned earlier that there are issues around things like copyright infringement. You You also said that predictive AI is safer than generative AI. How does that fit into what's happening in the regulation world? How is regulation going to evolve, and can we look forward to better regulation?
I hope so. Generative AI needs substantial AI regulation as quickly as possible. The technology is capable of moving so much faster than legislative bodies are. We're already so far behind what should be in place at this stage with respect to, especially with respect to likeness appropriation. I mean, there are really no laws governing the appropriation of someone's likeness and use in a creative context that they didn't consent to. I mean, that seems nuts. Like that absolutely should be top of mind, but it hasn't really been possible thus far. And so we don't have laws that protect against that. AI can do it extremely convincingly. And within the next few months, it will be hard to tell that face and that voice from the actual person. So, that and obviously the appropriation of the original artworks that are seeding these engines. You got companies that are worth billions of dollars who have trained their engines for free on content created by people that weren't compensated. Those are huge issues. On the predictive AI side, I mean, obviously, I'm biased. This is the area in which I work. Now, I should say, I'm a fan of all AI. So, predictive AI is my area of expertise and where I choose to work, but I'm not a generative AI hater. Predictive AI, our danger is that while AI, the predictive AI is extremely good at identifying patterns, it's possible for predictive AI to create patterns. So if you had an enormous $1 trillion asset manager with complete and total access to order flow all the way down to the floor, then it's possible for your order entry systems to segment their buying and selling, all as part of a randomization scheme, which is completely legal, in such a way that creates a pattern that you know will be interpreted by other predictive AI systems in a specific way. So, really, now you've got machine trying to fool machine. That's where we need the regulation to step in and say, okay, if you want to use these to do deep dive mathematics for pattern recognition, fine. That's an advantage that the market gives you. The data are available to everybody. Have at it. However, you cannot then turn around and segment your order flow to manipulate others. I mean, we've got regulations that cover order flow market manipulation. They don't really get to the point of being sophisticated enough to deal with this. So I think that's where we're at, and that's where we need to go.
I want to ask how our listeners can learn more about working with you. Let's start with the ETF. You mentioned the symbol. What's the symbol again? Is the expense ratio? What are the other considerations? What's the assets under management that our listeners would want to know when it comes to your ETF? And then more broadly, how else can you work with advisors or even with asset managers?
With respect to the ETF, the ticker is DIP. It's listed on the New York Stock Exchange. Citadel is the direct market maker on the floor. They handle our ETF and bond. So we're in good company, although the AUM disparity is rather large between the two.
And bond is Jeffrey Gundlach's ETF.
Yeah, its expense ratio. We started with an expense ratio of 125 basis points, which frankly was charity on our part. Coming from the private fund side, it was not seen that way by the savvy ETF investor. So we spent a lot of time last year creating additional efficiencies within our systems, so that we could drop the expense fees down to 75 basis points. So in line with more actively managed ETFs. It behooves me to say that AI curated and directed ETFs do not carry the same costs as three or four folks sitting around in a room doing a quarterly rebalance. It's the Amazon Web Services fees could choke an elephant. But we recognize that that's part of the solution we're trying to provide. And if it's too expensive, that's going to be a barrier to entry. So we're willing to absorb some more of the cost there and essentially subsidize it in the short term so that we can reach the greatest number of people. In terms of the private funds, two of them are subscribable to accredited investors. And the solutions that we've created on the private side are licensable. So we do license access to our strategies for in different capital allocations. Some of the strategies that we use have maximum capital allocations. So once they're fully licensed, we can't offer access to anybody else. It's just a byproduct of AI strategies. They're not all limitless. Our larger strategies, such as Helix, for example, has an unlimited capital allocation because of the universe that it works within. And any amount of that is licensable. And information on all of that can be found at www.kaiju.ai.
If there's one key takeaway that you would like to leave with our audience of financial advisors about how predictive AI will transform investment products, what would that be?
I'd like to say be cautiously optimistic. I mean, with the media, there's a lot of doom and gloom. And while there's the capacity for AI to do a lot of harm, I believe there's a greater capacity for it to do a lot of good. It can empower better financial decision making through risk evaluation. It can find and perform cursory evaluations on salient information that would be difficult for a human to do in any sort of reasonable time frame. When it comes to predictive AI, it's a vastly faster, superior mathematician than any human. And that capability can and will continue to be yoked to the investor's benefit. So, I know we're a year and a half away from crypto implosion. And here we have yet another new technology that's at times difficult to understand, especially black box environments and a lack of explainability. And you've got another cohort of experts all saying, "Don't worry, we've got this. It's safe. It's fine." I am more than supportive of a heavy dose of skepticism on the part of the investing populace. But this technology is here. It's here to stay. It will continue to grow, and it can provide substantial benefit. So be cautiously optimistic.
Well, thank you. And we'll include some links where you can learn more about Ryan and Kaiju in the notes that accompany this podcast. There'll be a link to Ryan's bio, where he is a member of the Forbes Council. Ryan, is there anything else you'd like to add?
I think you've covered it all, Bob. I am grateful for you having us on. This is the first big podcast we've done in a while, and it's great to be able to talk to an investing community such as yours.
Well, you're welcome. And thank you for listening to the Gaining Perspective podcast with Bob Hoopsher, today featuring Ryan Pinnell of Kaiju Worldwide. To support our podcast, please share, subscribe, or leave a review to help make our podcast more findable for your friends and colleagues. You can subscribe to Gaining Perspective on your favorite podcasting service.